Quick headline to start. The European Commission has issued preliminary findings that TikTok's design elements like infinite scroll, autoplay, push notifications, and its recommendation engine likely breach the EU's Digital Services Act, especially because they can encourage compulsive use among kids and vulnerable adults.
That's right. Brussels says current parental controls and time limits aren't enough. TikTok has pushed back hard, calling the findings categorically false, but the company will get a chance to respond before any final decision. If found non-compliant, changes to core features or fines up to 6% of global turnover are on the table.
So what exactly does the DSA require here, and how plausible is it that regulators force changes to the product itself?
The DSA demands platforms assess and mitigate systemic risks, including harms from design that promotes compulsive use. Regulators can order technical or design changes if features demonstrably harm users. Infinite scroll and autoplay are obvious targets because they reduce friction to disengage. That's literally the design element regulators flagged.
Could this become a blueprint for other regulators worldwide?
Absolutely. If Brussels succeeds, it gives other jurisdictions a playbook. Tech firms will have to show stronger impact assessments, especially for minors, and product teams might finally have to argue for ethics as much as engagement.
Charming thought, regulators as the new UX reviewers. Imagine compliance tickets in Jira. Next up, Stellantis announced a $22 billion charge as it admits it overestimated how fast customers would switch to BEVs. The company is selling its stake in an Ontario battery joint venture to LG and shifting focus back toward gasoline and hybrid models.
The market reacted violently. Shares plunged roughly 25–30%. Stellantis essentially admitted operational execution and market timing were off. The write-down reflects excess EV investments, slow sales for some models, and the need to reset expectations.
Why such a massive hit? Is this an industry-wide reality check or specific to Stellantis?
Both. Several automakers misjudged adoption curves, subsidy tails, charging infrastructure pace, and consumer preference nuances. Stellantis' portfolio is broad. Jeep, Peugeot, Fiat, and some segments still prefer combustion or hybrids. The charge recognizes stranded assets, tooling, battery contracts, development costs.
Any wider implications? Suppliers, battery plants, or climate policy?
Suppliers will feel pressure. Battery plants could see consolidation. It may slow the rollout of some EV models and influence investors to demand clearer route to profitability. From a climate perspective, it's a bump, not a derailment. Automakers will still electrify, but perhaps more pragmatically and regionally phased.
Translation, fewer niche EVs for now, more spreadsheets in boardrooms. At least the spreadsheets don't need charging stations. Moving on to Apple. Reports say the company has wound down its big AI health coach project, often nicknamed Project Mulberry or Apple Health Plus. Instead of shipping an all-in-one coach, Apple will roll individual features into the health app and maybe launch an interim AI health chatbot.
The pivot follows a management reshuffle. Services chief Eddie Q took over health and decided a phased approach is faster and less risky. Apple reportedly produced videos and recommendation logic that will be repurposed, and some personalized suggestions could arrive in iOS updates soon.
Why scale down now? Is this about competition, liability, or just product market fit?
All of the above. Health is heavily regulated and carries liability risk if an AI gives poor advice. Competition is fierce. Companies like OpenAI, Aura, Whoop, and specialized health startups are moving quickly. Apple seems to prefer shipping smaller, vetted components integrated into existing user flows rather than a standalone product that could raise expectations and regulatory scrutiny.
Does this mean Apple is retreating from health innovation?
Not really. It's reprioritizing. Incremental releases let them test accuracy, privacy controls, and user adoption without overcommitting. Think of it as Apple doing surgical feature launches instead of a single cliff dive.
So less Mulberry, more mold-over features. Safer for users, less dramatic for marketing teams. Last story. OpenAI leadership has publicly reinforced their dependence on Nvidia GPUs after market chatter about alternatives. Sam Altman praised Nvidia, and OpenAI's head of compute said their fleet runs on Nvidia hardware.
That's a strategic message to investors and customers. OpenAI values Nvidia's hardware performance leadership and software ecosystem. The partnership includes tight code design and optimization, not just boxes of GPUs, but tool chains, libraries, and experience.
Could other vendors realistically displace Nvidia at scale anytime soon?
It's possible, but hard. Switching costs are massive. Software stack compatibility, retraining models, integration work, and proven performance at scale. Alternatives like TPUs or newer startups have promise, but they need ecosystem maturity and volume. For now, Nvidia's combination of hardware, software, and partner relationships is dominant.
That concentration makes investors nervous, though, right?
Exactly. Heavy investor concentration in one supplier or one stock creates systemic risk. It's healthy for the industry to see competition, but these transitions take years. In the short term, reaffirmations from OpenAI calm markets and signal stability for customers.
So Nvidia stays king of the GPU hill, at least until someone invents a faster hill. The preceding audio summary was created at jesterengine.com, where you can find and verify the original sources.